My next guest has worked in emerging markets for more than 4 decades. He's seen Russia's currency collapse before. He's witnessed globalization and now its apparent reversal. And he sees several opportunities and safe havens for investors right now. Joining us is Mark Mobius. He's the founding partner at Mobius Capital Partners. Mark, great to have you on a day like this. What is your knee-jerk reaction? What are markets telling us about the shape that the U.S. And global growth are about to take?
Well, the interesting thing is that you got a number of winners as well as losers. You know, a lot of people think all the markets are down. That's not the case. For example, in emerging markets, Brazil is up substantially. South Africa, of all places, is up. Now, of course, I can explain that because of raw material prices, maybe. But generally speaking, it's a great opportunity to pick and choose the winners and losers. There'll be winners and losers. My guess is, as a result of what's happening in Europe, China will be a winner because Russia will have to trade more with China. They'll have to depend on China more and more. So we have to be very, very careful in looking at these markets and not becoming too pessimistic about what's happening.
Yeah, fair enough. If I can ask you just one more about the U.S. in general, do you think this economy is going to slow? You know, what's going to happen with the dollar? What does that mean for some of the, the fund flows that you're kind of watching around the world? If China is going to hold up relatively well, maybe we can too. It sounds like that's not necessarily, a slowdown story so much as maybe still an inflation story that we're going to be grappling with in the months to come.
Well, one thing you've got to remember is that just because there's inflation doesn't mean that the market has to go down. If you look at history, you see that inflation is not correlated with the S&P 500, for example. Of course, it's correlated with the fixed income market. But what you have to do is figure that where are people going to go as a safe haven from Europe? That's America. America is the place to be. The U.S. dollar is the place to be. So I think the U.S. will do fairly well. Of course, the market is not doing well. It's down. But I don't think it's going to stay down. I think you're going to see recovery. And I think inflation, with those companies that are able to price their products in the inflationary environment, they'll do very, very well. And of course, there are a lot of them like that in that category.
Yeah, and that's good news for our debt. Obviously, it's going to keep those longer-term borrowing costs down. So on the dollar, you think that that attraction of flows is going to keep the dollar higher? Isn't that normally a headwind for a lot of these emerging markets?
Well, yeah, there is, in some cases, a headwind for some emerging markets. But as I mentioned, in dollar terms, Brazil and South Africa are up. That's even accounting the local currencies, which are usually not that strong. But it's really a mixed picture. But generally speaking, in times of stress, people go to the U.S. dollar.
All right, fair enough. Let's talk about some of the real specifics where you do see opportunities right now. They include some countries, gold, which I'm seeing more and more people look at charts and get excited about. And so maybe you can give us a sense of where you think the best opportunities are right now.
Well, as you know, I've been a gold bull for quite some time, but I don't recommend people put all their money into gold. I'm saying about 10% in gold is fine. Physical gold, that is, not ATFs, ETFs, or anything like that. But the other area, of course, is equities. You've got to be in equities in order to beat inflation. Otherwise, you're going to be in trouble. And, of course, you've got to be diversified. What's happening now in Europe teaches a big lesson of diversification. So those people who had money in Brazil and South Africa, in parts of Asia, are doing fine and not being hurt so much. And of course, American stocks, some of the American stocks that have exposure to those countries is also a place to be. But I would say equities, first of all, and second of all, companies that have no debt or very little debt. Because with interest rates going up, companies with high debt are going to be in trouble.